DKS Sporting Goods just reported a 62.7% revenue surge, but the stock still dropped. So is DKS becoming a stronger sports retail empire, or is the Foot Locker deal quietly eating the profits? Today, we are breaking down DKS first quarter fiscal 2026 results, released on May 27, 2026. This is not just a normal retail earnings report. It is the first clear test of DKS after absorbing Foot Locker, one of the most important sneaker retailers in America. The headline number was massive. Net sales reached $5.17 billion, compared with $3.17 billion a year ago. That is a year-over-year increase of 62.7%, driven mainly by the addition of Foot Locker and continued strength in the core DKS business. Wall Street expected revenue of about $5.09 billion. DKS delivered $5.17 billion, so the top line beat expectations by roughly $80 million, and the business clearly gained scale after the acquisition. But the earnings story was more complicated. Adjusted earnings per share came in at $2.90, just below the $2.92 analysts expected. GAAP earnings per diluted share were $3.54, up from $3.24 last year. Net income was $319.8 million, compared with $264.3 million 1 year ago. That looks positive on the surface, but investors focused on what it cost to get there. The company recorded $96.5 million of acquisition-related charges in the quarter. $53.8 million came from merger and integration costs, including severance and store closings. Another $42.7 million came from inventory markdowns and clearance activity. That is why this quarter is so interesting. DKS is bigger, revenue is higher, and Foot Locker is showing early signs of recovery. But integration costs, dilution, and margin pressure are making the profit picture messier than the sales chart. Now let's separate the two engines. The DKS business, which includes DKS Sporting Goods, Golf Galaxy, Going Gone, Public Lands, and Game Changer, produced about $3.4 billion in net sales and delivered 6% comparable sales growth. That 6% comp growth matters because it came from both higher average ticket and higher transactions. In plain English, customers were visiting more, buying more, and spending more across footwear, apparel, and hardlines. The Foot Locker business contributed about $1.8 billion in net sales. More importantly, Foot Locker returned to positive comparable sales growth, with pro forma comps up 0.6% after being down 2.9% in the prior year period. Foot Locker US, the area where DKS is focusing much of the turnaround, performed even better. Comparable sales grew 6.4%. That is the clearest early sign that the new parent company may be improving store execution and merchandising. The combined pro forma comparable sales number was 4.1%. That is a strong result for a retailer operating in a consumer environment where shoppers are still selective, inflation is still a concern, and discretionary categories are being watched closely. The biggest turnaround project is called Fast Break. DKS expanded this capital-light Foot Locker remodel to about 100 stores globally during the first quarter, and management says it remains on track to reach roughly 250 stores by back-to-school season. Management said Fast Break stores are delivering double-digit comparable sales gains and better merchandise margins. If that continues, this program could become the key proof point that the Foot Locker acquisition was not just about buying sales, but buying a fixable asset. Now let's look at margins. Gross profit was about $1.68 billion, up 44.5% year over year, but gross margin contracted by 411 basis points because Foot Locker mix, markdowns, and acquisition-related inventory actions pressured profitability. GAAP operating margin was 8.7%, down 281 basis points from the prior year. Non-GAAP operating margin also declined, showing that even after adjustments, the company is dealing with real margin pressure as it integrates Foot Locker. Selling, general, and administrative expenses were $1.16 billion. The SG&A expense rate improved as a percentage of sales, but total dollars rose sharply because the company is now operating a much larger store base and carrying the integration workload. This is the central tension for investors. The scale advantage is real. The sports category is hot. Dick's core business is outperforming, but the market is asking whether the company can turn Foot Locker around without permanently lowering its margin profile. Guidance tells the story. Dick's now expects full-year fiscal 2026 net sales between $22.1 billion and $22.4 billion. That midpoint is around $22.25 billion, roughly in line with Wall Street expectations. For comparable sales, management actually raised the low end of the outlook. The Dick's business is now expected to grow between 2.5% and 4%, up from the prior 2% to 4% range. That is a small change, but it signals growing confidence in the turnaround. But earnings guidance was the problem. GAAP EPS guidance was updated to $13.27 to $14.27, down from the prior range of $13.70 to $14.70. So management is saying the underlying profit framework is still intact, but GAAP earnings are being weighed down by integration costs and accounting noise. The market reaction was cautious. Shares fell in pre-market trading after the report, and later commentary pointed to the trimmed GAAP EPS outlook and Foot Locker integration costs as the main concerns. Investors liked the sales growth, but they questioned the quality of earnings. Context story number one is the Foot Locker acquisition itself. Dick's bought Foot Locker to create a larger global sports retail platform, gain deeper sneaker exposure, and reach consumers through more banners. But buying a challenged retailer means inheriting challenged stores, inventory problems, and execution risk. Context story number two is consumer demand. Sports remain one of the strongest cultural categories in retail. Youth sports, athletic footwear, team gear, and performance apparel continue to drive traffic. That is why Dick's can post 6% comps, even while many retailers are fighting for growth. Context story number three is the Nike and sneaker ecosystem. Foot Locker has historically depended heavily on major athletic brands, especially Nike. If Dick's can improve allocations, remodel stores, and rebuild the consumer experience, Foot Locker could become a stronger profit contributor over time. The bull case is straightforward. Dick's has a best-in-class core business, positive transaction growth, strong sports demand, early Foot Locker comp improvement, and a remodeled program that appears to be working. If integration costs fade, earnings could re-accelerate. The bear case is just as clear. Revenue growth is being boosted by acquisition accounting. Non-GAAP EPS declined from last year. Margins contracted. Inventories are higher, and Foot Locker turnaround could take longer or cost more than management expects. So, should you buy DKS after these numbers? My view is balanced. This was not a clean beat and raise quarter. It was a strategic transition quarter. The business is bigger, and the long-term opportunity is real, but the market needs evidence that Foot Locker can improve margins, not just sales. For investors who already own DKS, the key numbers to watch next quarter are Dick's comps above 2.5%, Foot Locker comps staying positive, operating margin stabilization, and whether acquisition charges start moving toward management's full-year expectations. For investors who do not own it, patience may be valuable. If the stock sells off because of integration fears while the core business remains strong, that could create an opportunity. But if margin pressure keeps getting worse, the cheap-looking entry point may be a value trap. Bottom line, DKS delivered $5.17 billion in revenue, 62.7% sales growth, 6% Dick's comp growth, positive Foot Locker comps, and $319.8 million in net income. But the earnings quality debate is not over. This quarter proves Dick's can grow. The The next few quarters need to prove it can grow profitably with Foot Locker inside the company. That is the real story investors should watch. If this breakdown helped you, like the video, subscribe for more weekly deep dives, and comment below. Is DKS building a sports retail powerhouse or taking on too much risk?